So over the past few weeks, there's been a lot of volatility within the market. If you look at the fear greed index, it's down to 14 at extreme fear and ranging within the 20s during this past few weeks. You also saw a lot of positions getting blown out with the stock market losing more than $700 billion on a daily basis. And then finally, if you take a look at this research right over here by Coinbase, we see some of the largest liquidation in recent crypto history, with October right over here when the crypto market was trending up to $4 trillion. Some of the largest long liquidations, also short liquidation as well, but the longs really got liquidated recently with the market downturn. So right now there is a really bearish sentiment, especially in the crypto market. If we just go back 1 month on October 6th, that's when BTC hit 126Ks and since then has pulled back about 22%. But if we compare that to the previous cycle, you can see back in the 2017 and then also some extent in the 2020, there's been more than 38% pullback on some of these major pullbacks during those markets as BTC continues to make a higher high. But if you compare that to our current cycle, there's been more than 7 times where BTC has dropped about 20%, only once during that May-April tariff Armageddon where it dropped 32%. So these corrections, in my opinion, are healthy and normal. We see them in every single bull market. Now, I like this quote right over here by Peter Lynch where he talks about far more money has been lost by investors in anticipating these corrections than the actual corrections themselves. So it's extremely hard to time these corrections. If you're a day trader, I get it. I don't do any day trading, but as a long-term investor, I try to not time these corrections because it's literally impossible to predict them all. Now, if you zoom out and you take a look at the big picture, you can see right over here, Eric Balchunas has pointed this out, that since the ETF launch in 2023, BTC has gone up more than 320%. And if you annualize that, it's still up 80% year to year. And then if you take a zoom out from the bottom of the last bear market in 2022 to now, BTC has clocked in more than 740%. So even with this recent pullback, long-term investors remain optimistic, continue to buy in strength. You can see from the stock market ETFs right over here, over $47 billion as purchased this week. Also, if you check out all the ETH whales, they continue to buy ETH in strength, $1.3 billion, including Bitmine, BMNR purchasing ETH. And if you look at JP Morgan's recent 13F filings right over here, you can see that they disclosed that they purchased, starting from September, they've got almost 2 million shares of BMNR, which means they own a proxy to ETH. And if you take a look at Vanguard, Vanguard also disclosed on their 13F that they also own BMNR as well. So you could see that lots of institutions continue to buy in strength. So in my opinion, Bitcoin has entered a new territory, becoming an institutional asset class that people are buying. Yes, there's been some headwinds, the government closing down, there's been tariff scares again, there's been talks about rate cuts ending. So a lot of stuff with OG whales selling out. They rightfully deserve those profits as they've been holding on for a very long time. Now, a lot of companies are putting Bitcoin onto their balance sheet. You're talking about nation states. You're talking about the buyer not being the average degen that used to purchase it in the past. So Bitcoin's volatility is going to be dampened over time as more institutional adoption continues to happen. So in today's video, I'm going to be talking about Bitcoin. I'll also talk about how Ethereum scales up to be that institutional asset class. And then finally, I'm going to talk about how the feds are using their monetary policy, aka their plumbing tools, in order to get that liquidity to us. So before I get started, welcome. My name is Colin. For those of you who are new around here, what I do is I do fundamental analysis on stock and crypto projects that I feel have long-term value. Remember that none of this is financial or investment advice. The crypto market and stock market is incredibly volatile. You risk losing your capital. Furthermore, this is not a sponsored video. I'm not here to sell you anything. Full disclosure, I own BMNR, I own ETH, I own BTC. If you like what you hear from today and learned something, please consider subscribing, liking the video, and then if you're on X, please consider following me where I can tweet out this information much faster than I can make a video. So if that out of the way, let's get started. So Bitcoin continues to dominate growth as a global asset class. If you look at work done by Jesse Myers right over here, he does a great summary showing that Bitcoin back in 2023 was only 400 billion of the 900 trillion in terms of global asset value. So fast forward 2 years later, Bitcoin is now 5x'd it. It's over $2 trillion compared to the total global asset value of 1,000 trillion. So total global assets have been growing at about 6% a year, whereas Bitcoin is clocking 120% compared to the fiat stuff, bonds and money that's only growing at 3-4%. So the interesting thing about Jesse's work is that Michael Saylor used his own number, plugged it in. He said that Bitcoin is roughly 0.2% right now, and he predicts that in 20 years it's going to grow to 7% of total global assets. So if we look at the results of what Saylor actually predicted, okay, for the next sort of 20 years compared to what's happening, So he predicted a 29%, 30% growth over the next 2 decades, right? Plus 22% relative. You could see what's actually happened since his prediction. Bitcoin's growing at 120%. Whereas gold is actually going at 35%. I think interesting to point out that, Saylor didn't anticipate this because right now people are running away from fiat. And of course, they're still running towards the traditional safe haven, which is gold. But what's even more important is take a look right over here. Saylor said that, he predicts that bonds and money will grow at 5-7%. Right here, they're only growing at 3-4%. And relative to the total, they're actually going in the minus direction. So you can see that as fiat continues to be debased, people are running towards hard assets that cannot be duplicated. There will not be more than 16 to 21 million Bitcoins ever created. So what about ETH? If we look at ETH, I believe ETH is in a very solid position to be adopted as the backbone of our global financial system. Now, I say that because, as you see, lots of financial Wall Street firms are adopting it. Banks, asset managers, and lots of DATs. There's more than 70 DATs that are buying ETH. But what's more important is that ETH provides that security, that robustness. The one question about ETH has always been, can it scale? Can it scale like Solana, Sui, other blockchains where it can be used and adopted as a global finance system? So let's answer that right now. So the holy grail of blockchain technology is this trilemma right over here. So if you're new to crypto, I'm just going to remind everybody, so no one would ever argue, is ETH secured? Yes, it is. It's probably the most secured L1. Now, number 2, is it decentralized? If you look at the stats right now, ETH is one of the most decentralized blockchain with over 1 million validators. The question for me has always been, is ETH scalable? Because if you've been around for the last 2 cycles, you know that ETH is incredibly slow and it is incredibly expensive to use until now. As we see all the upgrades that are coming in, we see that ETH is getting better and better, and let me show you the data to it. So if we look at scalability, we look at 2 things. Number 1 is how fast, the transaction per second, the time to finality. Number 2 is how much does it cost, because if it's too expensive, you can't really use it. If you look at the last few cycles, people always point this out right over here. Now, I'm not picking on Solana. I actually own some Solana. I own some Sui as well. But if you take a look right over here, ETH compared to everybody else was really expensive, really slow. Now, since then, ETH has done a lot in terms of its upgrade and its L2. But if we look at some of the transaction costs, we can see some of the ridiculous costs during the last NFT, 2021 bull market run. Right over here, somebody tried to execute a $700 transaction. It cost $148. Right over here, the transaction itself was $1,600, whereas the transaction fee was over $1,900. Now, minting NFTs during the last cycle was a little bit crazy because we saw prices like this, especially with the BAYC. The other side, there was a transaction that failed that cost over $10,000 trying to mint the other side right over here. So for those of you who are new to this crypto cycle, you could see why people in the past has been really bothered by ETH in terms of how slow it is, how expensive it is. But like I said, since all of the upgrades, all of the L2, what is ETH doing right now? If we take a look at the data, and you can look these up itself, you could see that right now on any given day, depending on how much traffic, so these numbers change all the time. But if you combine all the L2s like Base, like Optimism, like Arbitrum, all the L2s, and there's more than 100 layer 2s that is built on Ethereum, you could see that it can execute up to 6, 7, 8,000 transactions per second. And at that peak, just those 24 hours, and this depends on the data, what's happening that day, how much transaction that's going through, it's executed over 24,000 transactions per second. Now, that is extremely fast, and that is why ETH has really been scaling up in terms of its throughput, how many transactions it can get through at the same time. So besides TPS transaction per second, if we look at the cost right over here, considering all the L2s, it's less than a fraction of a penny. And if you consider ETH right over here, yes, sometimes it's more expensive when the network is congested, but compared to the 2021 bull run, the NFT mania where people were minting stuff on ETH, these transaction costs are pennies on a dollar. So is it scalable in terms of the speed with the L2s helping? Yes. The transaction costs at these costs, it's going to make you wiring money or, people wiring stable coins, USDT, USDC, instead of waiting a day, 2, or even 3 days over the bank, they're going to be able to do it instantaneously, costing them less than a penny every single transaction. And we look at the L2 ecosystem. Here's some research from the Ethereum Foundation. There's more than $47 billion of TVL total value locked. Right now, it's cost fractions on a penny right over here. Running hundreds of millions of transactions, more than 155 L2s that are operating, allowing for a high throughput, low transaction, becoming a global scaling for application, payments, and tokenization. And then also the L2s tap in that security of Ethereum being the L1 with more than 1 million validators. So if we go back to this blockchain trilemma and ask ourselves, is Ethereum the blockchain that will be able to deliver all three things? Yes, it's secured. For sure, it's decentralized. And now with the new L2s and the scaling solution that Ethereum puts through, it certainly checks off the box in my opinion, and it's going to get better and better every day in terms of its scalability. So right now we've seen a major pullback. Bitcoin's trading roughly at 100Ks. There's a lot of fear within the market, and we're waiting for that next leg up. Well, that next leg up is only going to happen when liquidity gets pushed within the market. So for the next segment of this video, I want to spend time on talking about Fed's monetary policy, how they push that liquidity around. So if you missed my last video, I talked about BTC, ETH, and risk assets like stocks being very closely correlated with liquidity. Why? Because liquidity is the single most important global macro variable. If we look back at the charts, what Raoul Pal was talking about, notice right over here, liquidity matches almost perfectly with BTC's pricing. And we plot them on a regression plot. We talked about this last time. Liquidity explains 90% of BTC's prices. Also with the tech stock, with the NASDAQ, if you plot it on a regression plot, you could see it explains 96% of what tech stocks do. So really the key thing is liquidity drives these risk asset prices. So is the liquidity still on the way? And the answer is yes. We still haven't seen it yet. So let me talk about why that liquidity is still coming. So I'm going to talk about how the Federal Reserves use their monetary tools, what I call their plumbing tools, in order to push liquidity into our banking system and the wider economy. Now I'll explain it in an easy way for me to understand it in a layman's term so that it may help some of you when you're reading stuff on X or watching things on TV so that you can better interpret these data. We're going to talk about QE and QT. We're also going to talk about the TGA, the Treasury General Account. We're going to then talk about the standing repo account and the reverse repo. So let's start first with explaining QE and QT so that it's applicable to us so we can understand how liquidity pushes asset prices up. So first off, QE is quantitative easing. All it means is that the Federal Reserve is printing money, so more dollars, so that they can buy assets onto their balance sheet, things like mortgage-backed securities, MBS, and treasury bills. By buying stuff, they're injecting liquidity within the financial markets. So QT is just the opposite. It's quantitative tightening. So what the Federal Reserves are doing is that they're selling these assets or letting these assets roll off their balance sheet, therefore sucking liquidity out of the financial markets. So the TLDR is simple. Whenever you see QE, all they're doing is turning on the money printer, injecting liquidity into the markets. When you see QE, they're turning off the money printer and sucking liquidity out of the market. To put this into practical use, if you look at the Fed's balance sheet right over here, in terms of their asset treasuries, MBSs, and loans, every time this line goes up, they're doing quantitative easing, right? They're buying things, putting liquidity into the market. Every time this line goes down right over here, they're doing quantitative tightening, taking liquidity out of the market. If we go back to 2008, during that subprime mortgage, that financial crisis, the collapse of many major investment banks, you can see that Feds did QE during that time. They actually did it 3 times, bought up all of those toxic mortgage-backed securities. They injected trillions of dollars in to keep the financial system, the liquidity within the system alive. Now, if you go to 2020, not too far ago, you can see they did QE again during COVID, where they were injecting money, lowering rates all the way to zero, saving the financial system again. Now, after 2022, it started to collapse. That liquidity started to collapse. Why? Because the Feds have been doing quantitative tightening, and they've been aggressively doing that since then to now. So next up, the Treasury General Account. So when you hear them talk about TGA, what is it? Well, think of it as our US government's checking account that sits with the Federal Reserves. So if you look at the mechanics, when they take in revenues like taxing, when Uncle Sam's taxes you, or when they borrow $1 from the bank or selling bonds, treasury, that Treasury General Account, that checking account goes up, right? Because they're bringing in money. Whereas when they're spending money, like paying out salaries to government employees, which is exactly what they're not doing right now as the government is shut down, benefits, contract money goes out. So the TGA should decrease during that time. So right now we're in day 39 of the shutdown. So you could see that the TGA should be building up. That checking account of our federal government should be building up. So that's an important detail that we're going to pay attention to. So the easy way to interpret the TGA is that every time the TGA is built up, money and liquidity is being drawn out of the system because our federal government is building up their checking account. Whereas whenever the TGA balance drops or decreases, it means that money is flowing, liquidity is flowing into the system. So if we look at the government's actual TGA and if we zoom in into this area from sort of July to October of this year, we can see that they've been building up that TGA. Right now, the TGA is sitting at almost $960 billion. And just from October right over here, as the government is shutting down, they're not spending much because they're still taking in revenue, they're still taking in our taxes, but they're not really spending a lot. So the TGA has built up to almost $1 trillion sitting on their balance sheet. So next is the standing repo facility. This is the same when people say it's the overnight repurchase agreement. This is where banks go when they're running low on liquidity. They come for these cash, these short-term loan cash from the federal government, putting up treasuries as collateral. So whenever you hear people say repo usage is going up, all it means is that the banks need cash, they're short of liquidity, they need to borrow it. Wherever repo falls, it means that banks have ample amount of liquidity, they do not need cash right now, and there's ample liquidity within the market. So if we go over and we look at the government's repo account, we could see by zooming in that in October this year, the repo facilities have been used a lot. So what does it mean? It means that the banks are short of liquidity, they need to run to the government in order to get this liquidity and short-term loans. And then the last concept is a reverse repo. So we just talked about what repo is. Reverse repo is simply the opposite of that. This is when banks, money markets, they have a lot of cash on hand. They don't know what to do with it. It's sitting there idle. So they deposit this with the Federal Reserves to earn a small interest and some treasury as collateral. So whenever you hear about the reverse repo, simply think of it as a parking lot where banks go to dump excess liquidity. And the reverse repo account only increases when banks has a lot of cash on hand. So to see this better, remember the Fed's balance sheet right over here? At the end of COVID in 2022, the Feds have aggressively went into quantitative tightening. Why? Because they needed to reduce all of that excess liquidity that they pumped out during COVIDs, right? They've reduced the rate to zero. There's a lot of liquidity within the system. So by 2022, QE ended and then QT started. They did that so successfully, and that is evidence when we look at the reverse repo account. So we could see it right here on the Fed's reverse repo account. By the end of 2022, they started QT to fight that inflation that was caused during COVID when they pumped a lot of money in, reducing rates, pumping a lot of money in. With that action, notice that they reduced the reverse repo from $2.4 trillion down to almost zero, a reduction of 99% of that excess liquidity. And we look at all the US banks and their cash reserves. Back in 2021, they're sitting above $4 trillion, and now they're roughly at $2.9 trillion, therefore a reduction in $1.3 trillion. And if you look at work by James Lavish right over here, he talks about how the GDP of our economy is roughly $30.5 trillion. What the Federal Reserve deems as ample liquidity being 10% of GDP, which means it's $3 trillion. Right now, in 2025, we're actually sitting below that definition of what ample reserves of liquidity within the banking system is. So what's the Fed's next move? Well, right now, the Federal Reserves have talked about ending QT on December. So we know that's coming. They're also running on a $2 trillion deficit every single year. So where's this money going to come from? Well, the banks can't buy them up because they don't have that liquidity. So the reverse repo account has already been drained. As I showed you that, the money has already been drained since 2022. So what does that leave? It leaves the Feds as the last buyer. So expect the Feds to come in, start talking about not all-out quantitative easing, but expanding their balance sheet, buying up treasuries, buying up NBS, and pumping liquidity back into the system. And we could see that they're on this path already. They've already cut rates twice this year, back in October, and I believe upcoming in December, they'll cut rates again, and cutting rates all the way into 2026, especially when the new Fed chair takes over in May. If we look at the odds right now for December, it's roughly 66% that they're going to cut rates in December, whereas 33% of keeping the rates the same. If you look at the poly market odds, it's roughly the same, about 70% of getting a cut. And if we look at the statements put out by the New York Fed President John Williams right over here, he really talks about ending QT, so winding down on efforts to shrink its balance sheet on December 1st. That's what we talked about, and really expanding its balance sheet. He talks about how they're going to start purchasing as their next phase again. So even though the Feds don't go out fully and say that they're executing QE, eventually I believe that it has to happen at some point. And remember I talked about this last time, that debt refinancing cycle. There's about $10 trillion that the Feds need to refinance coming into the end of this year. So liquidity will flow into the market again when the federal government opens up. When they'll open up, nobody knows. Hopefully it will be by mid or at the end of November. But stocks and crypto like BTC, ETH will react first because they are the furthest out on the risk curve. And in a liquidity ample environment, you're going to see them shoot up first before all the other assets. And lastly, I'll summarize this post by Raoul Pal. He really is the liquidity guy when it comes to global macro. Now, what I got from it was that the liquidity flood is going to come. So as soon as the government shutdown ends, Treasury is going to start pumping in money. Why? Because that TGA account has been building up. QT is already ending. They talked about this ending. And like I said, the feds are starting to talk about QE, buying assets, buying bonds again. Rate cuts will continue to come. We are already seeing 2 of it. We're going to see 1 in December. That's our hope. And then coming into next year, hopefully they start flooding the market with that liquidity, driving up the risk assets during that final phase. Okay. So the US dollar right now, it's still pretty strong, but as it gets weakened, as we continue to cut rates, as we debase our currency, pumping more money in, you're going to see US dollar weakens, helps risk assets. Hopefully the tariff tantrums will end. You know, they're going to roll over the debt. At some point, they need to roll over that debt. Also, the Clarity Act should get approved. That's going to introduce more crypto regulation. You know, it's going to open up doors for a lot more major players to come in within the market. China and Japan continue to pump in their own liquidity. And then the business cycle, the ISM, continues to expand. So with all of these things aligning, I do think we get that final liquidity push into the market as soon as the government opens up. We see this in the end of 2025 going into 2026, going into that banana zone, that parabolic zone that they keep talking about. I know that was a lot of concepts to handle, but hopefully that helped you. It explained some of the things that you've been hearing on X, on CNBC and other places. So if you enjoyed this video and these concepts, please consider subscribing towards my channel, and I will see you guys next time.